Thanks a lot. Good afternoon, everyone. I'm Michael Pedroni. So in the next 10 minutes, I want to talk to you about three things. One is to make the point that market data is not just an issue for the most sophisticated investors who are the ones we represent, but it's also an issue very much for Main Street, for the pension funds ultimately who bear the cost of it. Secondly, I want to make the point around, as a representative of a trade association, how our members are experiencing their interaction with market data, how they're obtaining it, how they're using it. And then third, I want to talk a little bit about the regulatory framework and suggest that maybe there are some areas where, consistent with what we've just heard from ESMA and AFM, that there are some areas for potential change. So unfortunately, MFA does need a little bit of introduction, unlike ESMA and AFM. So just who are we? So we are a global trade association representing the asset management industry. We have an American center of gravity, but our network is global. We have fund managers who we represent, about 150 of them, across the US, Europe, and Asia. In addition to our fund managers, our network also includes banks, various service providers, law firms, accounting firms, administrators. And in addition to that, interestingly, we have institutional investors as part of our network. So we have 34 pension funds in the US and Europe who sit within our network and advise us on how they use our industry. Okay, so where'd we go? Okay, so market data. I want to make the point here that having availability, access to market data is a social good. It's in the best interest of a well-structured set of markets. And so what does it do? Well, it helps you with best execution principles. It helps you with price discovery, reducing information asymmetries, identifying price inefficiencies, capital formation, the ability to list and grow companies in Europe. It reduces barriers to entry to have good access to market data. So not only just the largest players can buy that market data, you can have mid-sized and smaller firms purchasing it as well. It lowers costs for end investors. It helps with risk management, risk reporting. So there are a lot of reasons why we think the European Union wrote in this reasonable commercial basis under MiFID Article 13, because ultimately it leads to a social good. I've put a graph up there just to give one example. These are IPOs in the US versus the EU. The US is certainly not the solution to the EU's problems, but it just gives you a sense of if you can work on the capital formation and price discovery side, that certainly is one input into how you get to a very robust IPO market, which I know is one of the objectives here under Capital Markets Union. Okay, so what exactly is market data and how do we use it? I think it's very important to distinguish between pre-trade market data and post-trade data. This distinction is critical for our members and for many others. So pre-trade data, what is that? Well, that's the data that is the set of quotes, the book of orders, bids and offers by different size before they get executed upon. So this is the order book per se. The post-trade data is where was this executed? Okay, so and as a side note, an important side note, that post-trade data, as Carson was just saying, there's a requirement under MiFIR that post-trade data be made available free of charge 15 minutes after publication, after transaction. We have ample evidence that that's not being respected across the various jurisdictions in the EU. Now, our members use both pre- and post-trade data. So when I say our members, really ultimately the end user of the asset management industry, which are the pension funds, charities, life insurance companies, and so forth, are the ones who benefit from having access to that pre- and post-trade data. What we're concerned about is that the current data and market licensing fees are not consistent with this requirement under MiFID and MiFIR to have data available on a transparent, efficient, reasonable commercial basis. This is not a chaos theory that I've graphed up here, although it looks a little bit like it at first blush. What we wanted to show is really what the market looks like. So you have our members here, investors and asset managers, who work through the brokers or work through SIs and MTFs, or they interact directly with the exchanges. And what they're doing is they're looking for the most effective price at which to transact. Now, a lot of that goes through the brokers, and the brokers then, will execute that order on the exchanges. They can execute that order on other, MTFs and so forth. But the vast share of the execution happens at the exchange level. So we haven't put any names up there, but of course there are a number of exchanges have a significant incumbent share here in Europe. So somewhere estimated around 60%. Then once the transaction occurs, you've got the post-trade data. So if you look down at the bottom, you've got pre-trade data, post-trade data. This whole system interacts with itself. So pre-trade data informs the price discovery process, feeds back into it, as does post-trade data. So what we wanted to make the point here is that there are multiple uses for this data, and it's being created by the transactions that then go through the exchanges. Okay, now this is not our graph. This is a graph from Copenhagen Economics. I think probably as everybody's familiar, there are a couple of different consulting reports out there. Copenhagen Economics tends to be friendlier to the asset management side. The other one tends to be friendlier to the exchanges. But what we wanted to show here is that in Europe, according to Copenhagen Economics, the 7 major exchanges that they've identified, these are the revenues that in 2018 that they received from sales of market data. Now, what they've done is they've put an average line here, so that's just the average of the blue bars. The lower line is what Copenhagen Economics estimates is the cost to the exchanges of producing that data. So they've estimated it's between 3 and 10 million per exchange. They said the maximum was 10 million, so they put that line at the 10 million mark. So you can think of this wedge as the wedge that's the markup cost for market data that's being charged by the exchanges. Now, two interesting features come out here. One is that there's a significant dispersion across exchanges, so not every exchange is doing the same thing. The second is that when you add this up in aggregate, if you take just these 7 major exchanges, the aggregate cost of producing the data is about 70 million. The average revenue they're receiving is about 950 million. So you can see a significant markup in the system. This is I don't know why it keeps flipping forward. This is a graph here that shows, it's indexed to 100 in the year 2007, and it's at the, 2007 was chosen because that was when MiFID 1 went into effect. And it shows what revenue, what market data services are contributing to the revenue. These are 2 major European exchanges here. And then we benchmark that against US exchanges. And the point of this graph is to show that over the last 12 years since MiFID 1 went live, revenues from market data for these 2 major exchanges have gone up 3.5-fold, so from 100 to above 350 in index terms for these 2 European exchanges, whereas other services are not going up. Those are the thin lines. And then the bottom orange line is the 2 significant US exchanges, and what it shows is that, yes, we have a problem of data markups in the US as well. It's not quite as extreme as or significant as what we're seeing in Europe, and that I can say is borne out by the anecdotal evidence from our members as well. So we just saw and by the way, one other thing to note on this graph here is that revenues, so the fees that we're hearing about in the that are coming, that our members are telling us about, I mean, there are multiple categories here. So there's access fees, site fees, distribution fees, display fees, non-display fees, delayed data fees, creating and storing derived data fees. So what does that mean? What is a derived data fee? What we're experiencing, or what our members are telling us, is, well, let me speak by way of example. When I go to the car dealer and I want to buy a car, the dealer doesn't charge me one price if I'm buying the car just to get around on weekends, and a different price if I'm using that car to drive to work. They don't care. They sell me the car at the same price. What the derived data does is it says, however your user, however the purchaser is using this data, they'll get charged a different fee depending on how they want to use that data. That's kind of what derived data does. And so it really ends up being a charge based on the value that the end user derives from it. Okay, so the regulatory framework. In brief, in the US, we have a similar problem. It's important to note that the market data issue is not a European-only issue. This is a global issue. In the US, the legislative framework comes from 1934, where we say that, it says that proprietary data, think sort of pre-trade market data in European terms, that it needs to be provided for the equitable allocation of reasonable dues, fees, and other charges. So sounds fairly familiar to the Article 13 of MIFIR. This is then the regulatory framework under Rule 19b4 that the SEC uses to enforce. Recently, the SEC has taken this issue quite seriously. They convened a roundtable in October of 2018. They actually rejected a fee increase that was filed by NASDAQ in October of 2018, and then very helpfully recently in May of 2019 gave guidance to exchanges to try to establish some ground lines for proprietary data fees. So we're seeing a good active engagement from the US regulator. In Europe, by comparison, the framework is not dissimilar. You have Article 13 of MIFIR, which we know has the reasonable commercial basis language, and then the regulatory framework that enforces that is the Commission Delegated regulation, which says, and I've underlined the key words here, the price of market data should be based on the cost of producing and disseminating and may include a reasonable margin, and then it goes on to say it may include an appropriate share of joint costs. So the reason I underline these is that these are relatively imprecise terms that allow for, I think, difference of interpretation. And perhaps I could leave you then with the idea that one of the things that could be done is to define those terms a little bit more precisely. This is, we've just heard from ESMA, so I won't summarize it. We found their report delivered last Thursday to be very helpful. But I think some of the key findings that ESMA had in it were, first of all, that MiFID II is not delivered on its objective to reduce the price of market data. We agree with that. Overall market data prices have increased, in particular data with high demand, that is non-display data. Remember when I talked about the going to buy a car and using it for a purpose that is, perhaps not the traditional purpose, being charged more for that. We agree with that. We agree with all of these findings here. We also, don't want to get into consolidated tape in this discussion. We think that's a valuable tool, but it certainly it doesn't solve the reasonable commercial basis issue. So some concluding thoughts then. I would pose the question, why do exchange market data costs continue to rise? I mentioned the 6 or 7 categories of different fees that are being charged. Do those terms that we flagged under the delegated regulation, reasonable margin, appropriate share of joint costs, this is sort of cross-subsidization, do those need further definition so that there's a bit more clarity around the terms? Should the EU work to standardize some of the other data licensing barriers, auditing, burden of proof for data usage, contract terminology and definitions? So I think our members have reported to us that they experience very different enforcement type actions from the various exchanges. The German Finance Ministry came out with a very useful consultation on MiFID in which they posed the question, should this rather be handled by competition authorities as opposed to regulatory authorities? I don't know what the answer to that is. We certainly think there is a regulatory solution to this. And then lastly, should IOSCO take up the work on this issue? We are, currently thinking about whether it makes sense to encourage IOSCO to given that it's not a European-only problem, a global problem, for IOSCO to take on this work. So with that, let me finish. Thank you.